Okay, before we head in, a reminder for some important dates. The applied level, July 31st is the deadline for the all-included applied level. That is 38 days away. I'm going to repeat it every week just in case you're watching the calendar and you wanted this. 38 days. August 25th will be the last day for new positions in the market outlook. I do report that each week, not in a lot of detail. Once I start in the applied level, it will be in more detail. But the last day will be August 25th. Then it moves to the applied level in the portfolio construction module. But as I say up here, you must be an applied level subscriber, not just sector studies, applied options, or portfolio construction. If you're only subscribed to portfolio construction, you would not get the new positions in portfolio construction. So if you subscribe to the applied level by July 31st, new positions in portfolio construction will be included. From August 1st onwards, you still get everything. You still get portfolio construction module and the new additions I'm putting in portfolio construction, but you won't get new positions. That'll be an add-on module. Okay, this is the number to look at, 38. Next week, I can forecast almost with exact accuracy. I'll be reporting 31 days to you. Let's look at some of the economic data from last week. Last Tuesday, we got retail sales from the U.S. Forecast was for 0.2. This is month over month for May. Came in at 0.1, slightly lower. Retail sales ex autos 0.2 came in at negative 0.1, and you had revisions to the prior month down 0.2. X autos down 0.1, X autos and X gas down 0.3, and year over year to 2.7. Notice all the revisions downwards. To understand retail sales, let's sort of just take a small little seminar here. We get three looks at it. The first is called advanced, the second is preliminary, the third is revised. So for May would be our advanced look. When we get June, May will then go into preliminary, and then when we get July, May will then be the final revision. So we get three looks at it. It's a small sample that is used for the advanced look. It's a larger sample that's used for the preliminary. So the standard error is important. This is plus or minus 0.4. This is plus or minus 0.2. On a month-over-month basis, plus or minus 0.5 on a year-over-year basis. So a forecast of 0.2, given that the standard error is plus or minus 0.4, the forecast is saying it should statistically be no different than 0. It came in at 0.1, which is statistically no different than 0. So even though it came in at 0.1 instead of 0.2, it's a small sample, there's large sampling error, it is statistically no different than 0. Same with this number, statistically no different than 0. Same with this one, but this is significant year over year. When we look at the previous number, this is April now. This is April's preliminary number, negative 0.2. Standard error of 0.2. Your range is negative 0.4 to 0. Just includes 0 way at the other end of the distribution. So you can say, well, technically it's no different than 0, but I'm not willing to do that. It just touches the 0. I'd say, okay, well, that is significant. It is negative. X autos, it is negative, but this would be statistically no different than 0. But this is significant. This is X gas and X autos, negative 0.3, and then this is significant year over year. The other factor for retail sales is it is quantity times price. If you were going to deflate retail sales, you can't use CPI because CPI has services, big, huge part of services. And you wouldn't use CPI anyways, you'd use PCE. And in using PCE, you'd have to create a particular index that included retail, the retail sales categories and the food services categories and gasoline stations, which is rather challenging to do. So what we can take out of these numbers is one of two things. You can take out of these numbers that price is lower. Let's say that we hold quantity constant, price is lower. We have had evidence that based on the CPI that prices are abating. In the goods category, we saw a bunch of negative signs. So you could have prices dropping for retail sales with quantity the same, and that would produce negative numbers. That's not a bad thing. That's a good thing because it says that the Fed could lower rates. We really don't need 5.5%. If, on the other hand, you say, well, let's hold price constant, how do we get these numbers? Quantity is decreasing. Quantity is decreasing. That is a consumer that is fatigued. That speaks to lower levels of economic activity. The Fed can lower rates. So no matter how you look at it, this is a data point in favor of lower rates from the Fed. Industrial production, that came in at a nice number for May, month over month, up 0.9%. Previous was 0. The expectation was only 3. A year over year for May, 0.4 year over year. Wednesday, we got the National Association of Home Builders Housing Market Index, 43. This is a diffusion index, so anything less than 50 is contraction. Anything greater than 50 is expansion. We had 45 from last month, expecting 45, dropped to 43. High rates are doing their job there. We can see it in housing starts too. A negative revision on both the, not the 243. Negative revision on housing starts, 4.1. Expecting 0.7, got negative 5.5. Initial jobless claims, revision higher to 243 from the previous month. Expecting 235, got 238. And Philly Fed, expectation of 5, got 1.3. Lots of red arrows in here. So as far as economic activity, if we go to retail sales and we say, well, maybe it's not the price. If we construct a category, maybe it's 0 or slightly positive, but maybe not 0, then quantity is lower. That is consistent with what we're seeing in housing and initial jobless claims. The Philly Fed, all of this is pointing to softer economic activity. Mexico, retail sales, look at this, was expectation of being negative, was up 0.5. Year over year was expected up 1.5, up 3.2%. And the peso, by the end of last week, did find some strength, finishing just a little above 18, after almost threatening to print a 19 earlier in the week, found its way all the way down to 18. I'm still interested in the peso in 19 to 19.5. If we get a correction in the U.S. equity markets, if we get even a 5% pullback, the U.S. dollar will increase. That should put downward pressure on the peso. So rather than trading at 18 to the dollar, might trade in the 19 to 19.5. If it does, I would be interested in a long position on the peso there. Okay, a little bit more economic data here. Mexico, economic activity year over year for April, expectation 3.8. Previous reading negative 1.3. Look at that, 5.4%. Not so great month over month though, but year over year came in much higher than expected and much lower than expected for month over month. Heading over to Canada, our retail sales, 0.7. The expectation was for 0.7, came in as expected. Big increase from the negative 0.3, which was a downward revision to the month before. Combine that with retail sales ex autos month over month, 1.8%. Canadians are spending. Give them more money. They head to the malls. Look at PPI for May, 0. Expectation was for 0.5. There's 0. PPI year over year, 1.8%. Raw materials prices month over month in deflation here, negative 1%. This was marked down, revised down to 5.3%. The expectation was negative 0.6, came in at negative 1. Still elevated year over year for May, 7.6%, but you had significant run-ups in a lot of commodities. So retail sales for Canada looking good. Well, that doesn't speak well for more rate cuts from the Bank of Canada. So interest rate sensitive sectors didn't perform well last week. That explains REITs, or a little bit of REITs. Back to the U.S. leading index. This is the one that has been sort of questionable because it was in recession warning territory, and it's never been wrong. Every time it's gotten to that territory, there has been a recession, and then it started to bounce back up from that. The previous reading was negative 0.6, expected to only be negative 0.3, negative 0.5. So we're sort of heading back down on this one. There has been some criticism about the index of leading indicators because it's not really capturing the whole economy, a smaller and smaller part of the economy, but you can't ignore the number. Existing home sales month over month for May, negative 0.7. So housing, we could say housing has been in recession for some time. For automobiles, let's talk about autos for a minute. When we look at sales of every month, we get auto sales being reported, and they're down just slightly from the run rate that we saw the month before. EVs are down. Tesla's down probably the most in the EV category. I think something like 34% in Europe alone for 1 month, but shareholders just don't seem to care. One of the things I'm going to point out about inflation, and especially with vehicles, is it is tied to the interest rate. This actually surprised me because I went out last week, the week that just passed, looking to buy a new vehicle, looking at a pickup truck, a GMC Denali, fully loaded, beautiful looking truck. And I was talking to the dealer about the pricing, and he explained something about the price that you see on a vehicle as a function of financing. So as the interest rate goes up in the economy, the price of vehicles go up in the economy. They actually don't go down. The price of vehicles go up because one of the incentives that like a Ford or a GM would use is financing. So if the overnight rate is 5.5%, let's say that you can get a car loan for 10%. They'll offer something like 2.9% financing. Let's say this is GMAC. So GMAC, which is fully owned by GM, will offer 2.9% financing. GMAC sells bonds in the market backed by auto loans, and the coupon on these might be, let's say, 6.5%, and they're collecting 2.9%. How are they going to get that done? What GM does, because GM is selling the vehicle, is it gives to GMAC the present value of the difference between these two things over the term of the loan. And let's say that comes to $7,200. So when they sell that vehicle, GM then transfers to GMAC this $7,200. GMAC then puts that $7,200 into a money market fund, which earns interest over that period of time. And every month they have to make a payment. They collect 2.9%, plus they amortize a little of this 72 plus a little of the interest to get to the 6.5. And then whatever spread they make on top of that. So they might be targeting a number that's higher than that. This $7,200 is added to the price of the vehicle. So if let's say they could get this at 4.5%, the overnight rate is let's say 1.5%. They might only be offering 0.9%. Financing on that. The difference between the lower rate and here that might be $2,600, let's say, that was added to the price of the vehicle to compensate for the financing. So the difference between these two numbers increases the price of the vehicle you see on the lot. So the price of the vehicle you see on the lot is the price that already includes the 2.9% financing. So the dealer said, it is very important when you walk onto a lot and you're looking at vehicles is you say, I am paying cash. I am not paying, I don't want your financing, I am paying cash. Because the amount that is in the vehicle for the present value of the financing would come off. Right away would come off. So there was $6,500 in incentives to buy this vehicle, with $1,200 being from Costco. If you have a Costco membership, you get $1,200. So it went from $53 to $65. Another $65 came off for the financing because I'm paying cash. So it's actually $13,000 cheaper than what was listed on the window. I say this because as interest rates were going up, we saw prices of new vehicles going up as well, which dragged prices of used vehicles up. Once interest rates started to stay the same, you didn't continue to get those price increases on the vehicle because you didn't have to. Prices didn't have to go up because financing costs weren't going up. Once interest rates start coming down, you're going to see the price of that vehicle also come down because the present value of the difference between what GMAC has to pay and what it is receiving will also decrease. Isn't that interesting? Is the interest rate increases actually caused some of the inflation that the interest rate increases were meant to avoid. And it's the same thing with houses. You don't have a lot of spec houses being built right now because you can't, dealers don't want to pay to finance that inventory, which means you have less of supply on the market while you still have demand. We have enough evidence now, I think, that prices are coming down. We know technology keeps increasing. Technology is deflationary. And there is good evidence showing that higher interest rates are actually causing prices to stay elevated. So I really don't understand why the Fed wouldn't be instituting their first cut in July, other than a policy error, right? If you're following oil, the Baker Hughes oil rig count is important to pay attention to. The lower the rig count, the lower the productive capacity of the U.S. is 488, dropped to 485 for June 21st. Your total, the total rig counts, these are oil rig, this is total rig, 590 down to 588. It was a shortened trading week last week. Didn't really get a lot of important economic data. PCE is this week, so not surprising last week. Kind of a boring week in fixed income. Money market rates, again, pretty much well behaved. Capital market rates, slight increase, basically 3, 4, 5 basis points across the curve. Curve inversion still continues, 718 days on the 2 to the 10, over 600 days now on the 3-month to the 10-year. Balance sheet runoff, $9 billion, down to 6.692. This is going to be like watching paint dry. Balance sheet, 7.25 trillion. Last week, 7.25 trillion, down 6.4. The net, because this ran off 9, net was an increase of 2.586 billion. Money market funds. Look at this, a decrease. That's rare to see. 22.3 billion retail, no way. Increase 8 billion, both in government and prime. It's institutions that had a big decrease, 30 billion. Government down 28 billion, prime down 2.26 billion. I'm not sure how remittances work in the US. In Canada, there are quarterly remittances for corporations. You have to remit 4 times a year. You pay your taxes in advance. It is getting near the end of June. Perhaps there was a remittance last week, and that's why we have institutions that are down, as corporations were paying their quarterly installments. I don't know. I don't know how it works in the U.S. I should clarify. I've said a couple of times now here in Canada. I am back in Canada now. I got back on Wednesday, because it is the rainy season in Costa Rica, and the rainy season is mosquito season, and those two things I'm just not in on. So I came back to Canada, and it's been raining ever since I got here. But no mosquitoes. But it's the rainy season here. as well, I guess. I looked at the weather forecast. It's rain all into next week. Yay. July 31st, FOMC, 38 days away. We get the June minutes in 10 days. The probability of nothing happening increased slightly from last week, 90%. I think that's a policy mistake. I think they have enough information now to go 25 basis points. 10% on 25 basis points. I think once we see PCE, when I do this next Sunday, I think you'll see this number higher. I think it'll increase the odds for a rate cut in July. Let's go out to December 18th. Only one, either no or one rate cut last week had a probability of 30%. Now it's 33.9 of none or only one. Coming back to our calendar here, Canadian CPI in 2 days and Canadian GDP, our preliminary look at May in 5 days. This is going to be important for REITs. If this comes in hot, REITs will sell off a little bit more, which will give me an opportunity to buy more. I have been buying more with the price being weak. I can't quite figure out with the REITs, and I'll talk more about this later. I can't quite figure out with the Canadian REITs if they're weak because of the June 25th capital gains date, the date at which the inclusion rate jumps from 50% to 66%, or if the data are suggesting that the Bank of Canada will not cut rates at a speed at which investors would want to see. U.S. durable goods, 4 days, and U.S. GDP Q1, our final look at Q1 in 4 days. Mexico, if we're watching the peso, Mexico rate decision in 4 days, and U.S. PCE for May in 5 days. I expect that to track well with CPI and come in light enough to give the Fed another green light. Monday, Waller and Daly. Tuesday, Bowman is up twice, and Cook. Friday, you have Barkin and Bowman. Effective federal funds rate still sitting at 5.33. Reverse repo up 34 billion. It looked like it was going to print new lows. June 17th got down to 333 billion. The low was April 15th at 327. This was 333. I thought, okay, for sure we're going to break the 327, and then it just every day went higher into the weekend, up to 421. TGA up to 782 billion, up 131 billion week over week. Reserves 3.366 trillion, down 67 billion. Reverse repo plus reserves minus the 2.5 trillion target, 1.287 at 40 billion a month. Again, like watching paint dry here. This will be almost 3 years before they would be, I think, in the vicinity of ample, but we don't really know. It could be 2.4. It could be 2.1. I'm guessing 2.5 because last time they got around 1.9, all sorts of trouble happened in money markets. Okay, real rates, the 5, the 7, the 10 pull back a bit. The 20 and the 30 increase. This seems a little odd, and the sort of wrong move here is that your break-even rates increased. Looking at Fed funds rate, Q3 pricing in 18 basis points, Q4 pricing in 30.5 for a total of 48.5. Last week was 50.5, and summary of economic projections, the median has it at negative 25. I think the market is right on this one. In fact, I think you can go to negative 75 by Q4 and be right. Q1, 31 basis points, so over the next 3 quarters, 3 rate cuts, 1 per quarter on average. Last week was 80.5, hardly any change. Looking at TLT's performance over the week, down 0.75%. Not a lot of excitement here. Implied volatility sort of drifting away. SPX up 0.61%. I still think the 90 puts make a lot of sense, and I'd probably be looking to sell the 90 puts on any weakness in TLT. 30-year fixed rate mortgage, 6.87. had peaked over 7% for a couple of weeks ago. Now 6.87. 10-year Treasury was up 1 basis point over the observation period. 30-year FRM down 8 basis points, so the spread is down 9 to 262. OAS, all of them increased, but a little. I saw a story. Credit spreads widened last week on increased risk, and I thought, they didn't really widen. I mean, this is well within the range of boring. So no, I don't see that they've really widened. I still think they're rather tight. So I'm not on the exciting credit spread widening story. Let's look at new positions. I have added to Minto, to Interrent, and to Killam. I didn't add to Capri because I do have a sizable position as it is, and I thought, well, let's wait till I see CPI. If CPI comes in light, if the number gives, and PPI was light. If CPI comes in light and that sort of gives the light to more rate cuts from Bank of Canada, I will then, if Capri doesn't respond to that, I will then add more to Capri. Yes, I am going to gamble. GameStop, $25 puts, $4.30 for July. Why'd I do this? They're sitting on $3 billion of cash. And if they're wise, they will diversify away from their core business. They will become something else. Let's remember, Berkshire originally did this. It was a textile business, and then they're diversified away from that into insurance. The textile business eventually went away. So they had their shareholder meeting, but they didn't give any information on what they plan to do with that money. None at all. But I seem to think that it can hang out here for a while. This is pure speculation, by the way. Okay, so unless you want to speculate and you're willing to lose the money, don't copy this. It's just pure speculation. We'll see what they're going to do with the money. Goodyear Tire has been assigned to me at $12, average price $11.70. So I'm now long Goodyear Tire, which I have no problem with. I'll be looking to sell $12 calls on any strength at all, and probably head out to July and sell some 12s and even $11 puts on Goodyear. On semi, went out to September. The 65 puts had nice premium in there, 350. Sold those. And this actually came from a question last week from a viewer. Asked me what I thought about Heinz. So I did some looking on it, and yeah, I kind of like it. And it is at the bottom of a longer term channel where its price is. So I went out to August, the 32.50. There's not a lot of premium on this. There's not a lot of premium. If you're going out to July, it's almost not even worth it. So I looked at August, and 74 cents at the 32.50. That puts it pretty much near the bottom of like a long 2-year channel. I thought, why not? Let's give it a try. I didn't do a lot here. I only did 10 of these. I only did 10 because I'm not that familiar with Kraft Heinz, but I thought, why not grab it? Let's just, put it on the watch list. Let's get something going there. Okay, here's my watch list. My watch list has got a lot on here because I do think it would be healthy at this point for the market to have some kind of correction. It hasn't had a significant correction for some time. You've had inflows for the longest, 2 months running. You've had inflows over 2 months running, and all-time high after all-time high after all-time high. When it looks like economic data is softening in a number of different areas, how can you have all of these all-time highs? But here we are. So I think we're due for some kind of correction. So I have a watch list of what I want to do. GM at 44, AT&T $17 or $18 puts. I sold the $18 puts a while back, got 72 cents for them, and AT&T had a great week, finished well over 18, so those are paying off nicely. The GM, I'd sold $44 puts already, and they're in the money. not in the money, but I'm in a positive position on them in terms of unrealized profit. But I'd be looking to add more. GM at 44, AT&T at 17 or 18. Again, I'm waiting for a little pullback in the market. 2, 3, 4% correction. A 5% would be nice. 10% I think is long overdue, but I don't know that we get 10% as long as we keep saying those two letters again and again, AI, 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 and on and on and on, right? I don't know that you're going to get 10% as long as those words are around, but even a 2, 3, 4% pullback might bring these into play. This is purely on valuation, GM and AT&T. Oxy, Buffett bought more. He now owns 29%, so I'd be looking again at the 57.50s and the 60s. My 60s are paying nicely, so anything at 57.50 or 60. Newmont, still looking at the 40s. My previous 40s have expired. Newmont's sitting at 42 and change. I don't like the premiums on the 40s. I'll wait for a pullback. They recently got an upgrade to a buy from UBS with a price target of 50. That's what gave them support and brought them into the 42 range. Even though the price of gold was soft going into Friday, I think it was down like over 20 bucks, Newmont was still showing a gain for the week. Any weakness, I'll sell $40 puts on this one. IYR, the REIT index, I'd sell puts at 79 because my thesis here is we're going to get rate cuts, and rate cuts favor REITs. I am waiting for a pullback. TD, either 65 or $70 puts. This is a Canadian price. They also trade on the New York Stock Exchange. You can sell puts in American dollars. I'd be looking at Canadian dollar puts. This on the Montreal Exchange. Yeah, they have problems, but they've fallen just too far from mid-80s to where they are now. If I see good premium on the 70s and the 65s, I probably would sell puts on TD. Lamb Weston at 80. Lamb Weston is in the consumer staples, so if you ever bought frozen French fries anywhere in the grocery store, more likely Lamb Weston. They all through rate hiking cycle, they kept hitting 52-week highs, kept going up. And when you are performing like that, you miss on earnings even by a penny, you get punished. And well, they got punished. I'd be willing to sell the $80 puts because they've simply pulled back way too far for the financials that they provided. COMEX, still looking at $40 put. NextEra Energy, I had a chance last week and I just wasn't aggressive enough to sell some puts. They really plunged, and then the next day they fully recovered. It's I thought, oh come on. When I saw them dropping, I thought, okay, tomorrow they'll have one more day. This is not over. There'll be another day. Tomorrow I'll sell it, and then no, not at all. So NextEra or XLU both at 65. So COMEX, I'd sell puts at 40. NextEra and the XLU sell puts at 65. These are grid plays. Grid meaning the electrical grid is going to have to be upgraded. If you're going to shift your energy consumption from the gas pump to the home utility, AI is hugely energy intensive, and if you're going to increase the grid and shift the grid to greener energy, you're going to need copper. That's also going to require assets, and utilities have a guaranteed return based on the level of their assets. So all we have to do to forecast utilities is say, are their assets going to increase? Yes, they are. That means earnings are going to increase, period. So this is grid play. Valuation, GM and AT&T, upgrade, Newmont, whale watching, Oxy, Buffett really likes that, rate cuts, IYR, and just too far, TD and Lamb Weston. Okay, let's have a look at this interesting story here in the journal Nature. A matched case control analysis of autonomous versus human-driven vehicle accidents. What this study looked at is we're hearing a lot of things from AV companies that AV or advanced driver systems are safer than humans in terms of the number of accidents per million miles, for example. But this study says, well, you can't just look at that. You can't just look at how many miles are driven. You have to look at the type of miles that are driven. So it could be that a lot of the human driven vehicle accidents happen within city streets, but that drivers are more than likely to engage advanced driver systems on highways and less likely to do it on city streets. Or maybe it happens at night and drivers are less likely to engage the advanced driver system at night or during rainy conditions. So that it would appear that they're safer only because the driver has made the choice not to allow the advanced driving system to drive under those more risky conditions. So this study says you have to match them in terms of where they occur. You can't just look at the aggregate data and say, well, look at the difference in million miles. It's because you have a driver that makes the decision not to engage the advanced driving system under riskier conditions, thereby not giving it the chance to really have the same amount of accidents. So we're not going to go through the whole thing. The link, if you're interested in this, the link is in the description box, but it has a nice breakdown of the types of accidents. See, in daylight, dark lighting, dawn, dusk, no unusual conditions, dry surface, wet surface, clear, cloudy, and the type of accident, whether it was moderate, minor, no injury, sideswipe, head-on, rear end. A lot of interesting data, a lot of analysis if you're interested in looking at these. I think it did a fairly good job, but we'll just read some of the stuff here. A matched case control design, and that is what you have to do. You have to say, well, let's take all of the instances where advanced driving systems were driving within the city when it was raining versus human drivers in the city when it was raining, and let's look at that as opposed to just looking at aggregate data. A matched case control design was conducted to investigate the differential characteristics involving autonomous versus human-driven vehicles accidents. The analysis suggests that accidents of vehicles equipped with advanced driving systems generally have a lower chance of occurring than human-driven vehicles in most of the similar accident scenarios. However, accidents involving advanced driving systems occur more frequently than human-driven vehicle accidents under dawn, dusk, or turning conditions. That means if you're turning left or turning right, which is 5.25 and 1.98 times higher respectively. That means dawn, dusk conditions, the autonomous vehicle is 5.25 times more likely to have an accident than a human. And under turning conditions, turning left or turning right, almost twice as likely to have an accident than a human. What it does conclude is that it is safer under the more monotonous driving conditions, where a driver is more likely to get bored, distracted, or fall asleep. That it does better under the more monotonous driving conditions. That it's safer there. But once you get into the more challenging conditions, it is not safer. It is actually more dangerous. So if we're trying to handicap the speed of rollout of a nationwide robotaxi service that is not geofenced, I don't know that it is useful to bet money on aggregate data that says, look, per million miles driven, self-driving cars are way safer. Hence, we should be allowed to drive on all these roads. This study is showing that once you match the conditions, once you match the cases, there are conditions under which autonomous vehicles are safer. But the more important part of driving, the city driving, the turning conditions, because of course you got to turn, and within rainy conditions and even snowy conditions, that AVs, the self-driving vehicles, are not, in fact, safer. Regulators are going to lean in that direction, I believe, so that the concept, and I've said this before, the concept of a nationwide robotaxi service, level 4, level 5, coast to coast, minimum is a decade away. Minimum is a decade away. It's not August 8th, as Tesla would like you to believe. It is at least a decade away. This link is in the description box if you want to go into more detail with this article. Okay, let's look at SPY. This week hit another all-time high, 548.80. The 50-day moving average sitting at 522, which is just a little under 5% below where we finished. So again, any corrections are healthy. You can say we had a slight little one there. This is more like what we need to see. Those kind of corrections are healthy. This was a little too light. But to test the 50-day or to pull back to the 50-day would be just under 5%. The 200-day moving average is at 482. That is 12% down. That is well in correction territory. A 10% pullback would put us at 493. I just can't see it yet. I can't see 10% unless going into earnings season, earnings disappoint and guidance disappoints. Then you could, if you have a combination of a Fed which doesn't move in July, says nope, we're good, we're pretty much going to hang out here. If the Fed speak is along those lines of you'll be lucky to get one rate cut, and if earnings come in with disappointing guidance, you might get that, but I don't know. I don't hold out a lot of hope for 10%, but 5%, I don't think that's unrealistic. Looking at our forward 4-quarter operating earnings, 253.54 from LSEG, 250.40 from SPGlobal, closing SPX 54.64 gives us 21.69 times forward operating earnings versus 21.56. Every week we make it more expensive. Almost all on multiple expansion, because let's face it, you got earnings that increased by 12 cents over here and by 12 cents over here week over week. You're certainly not going to say, oh my God, earnings are up 12 cents. Let's increase this market. So the increase in the multiple really is just multiple expansion. It's just, you're just paying more for the same thing. Surprise factor 8% gives you over 20 times forward earnings if in fact for the next 4 quarters the actual operating earnings come in 8% above the expectation. If we're going to use the as reported numbers, 218.23 on earnings, you're at 26.25 times forward EPS. EPS, the forecasted EPS, operating earnings EPS, 26.25 times. Nosebleeds. Implied volatility, 33%, up from 11%. This is interesting. 27 up from 7, 21 up from 4. This is interesting that you're getting this implied volatility while you're also hitting all-time highs in the market. Now it could be because of Friday. Thursday and Friday were sell-off days in the market, while at the same time you had triple witching. You had options expiration, which does cause some volatility. So it could be that it was just that Friday that we're seeing that in the numbers, that those were the numbers as of Friday. You might have had just a spike to end the week, but that it really doesn't mean much more than that. We'll find out this week. Who's reporting this week? SPGlobal says 8. Sector Spider agrees, and I put them in orange, and they agree. They fully agree with each other. Wow, that's incredible. LSEG says no, there are 9. In fact, it says both SPGlobal and Sector Spider say Carnival is reporting Tuesday, LSEG begs to differ and say we think it's Monday. Also, let's throw Juniper in there for Tuesday, of which SPGlobal and SectorSPDR don't have at all. I don't know who you want to believe. So you got FedEx and Carnival on Tuesday. FedEx being, I think, the more critical one there. Wednesday, General Mills, Micron, and Paycheck. Everyone will be watching Micron. What a run-up it had. If you look at its chart, it did this, and then over the last 90 days, it just ran up, and then, had a little bit of a, well, not a little bit, $20 pullback in there, but really ran up. Micron is reporting Wednesday. General Mills is consumer staples. Same with McCormick. It's consumer staples. Consumer staples have not been doing well. They are both quite weak. I think consumer staples is a nice sector to start looking in, to start selling puts on some of these things, because, well, they are staples. If there is a correction in the market, they'll hold up very well. Thursday, you have Nike. I'd be looking at selling puts on weakness. They've come down quite a bit. They're not going anywhere. They're not going away. Walgreens, this thing is dying, isn't it? They've already instituted a dividend cut a couple of quarters ago. I think cut it in half. Is there going to be more? I mean, have a look at this chart, and it's a black diamond ski run. I mean, it's just straight downhill. But I don't know that I would be even interested in touching that thing. But McCormick, General Mills, a lot of things in the staples I think are coming into play. Even selling puts on XLP might be one of my new positions next week. We'll see how it goes. I know that we're coming into the next quarter's earnings, and I would like to get a good look at PCE first before I really commit to anything, but we'll see what earnings look like on these two. I'm sure the big talk of the town will be Micron. And it's nice to see that we're almost coming into agreement here. It's as if somebody from each of these companies are listening, going, yeah, he is right. I mean, this is an embarrassment. Let's clean it up. I think this is the first week where two of them are in full agreement with each other, and the third one is just off slightly. Let's see if we can actually pull something off for the weeks coming up. Earnings are starting soon. I think second week of July. Yeah, in the second week of July, which is we gotta get through 2 more weeks, and then we have earnings, and then of course we always start with the banks. And that's it.